I'm Matt Bishard with REIT.com here in Chicago for REITWeek 2013. Joining me for this CEO Spotlight is Phil Hawkins, CEO of DCT Industrial Trust. Phil, thanks for joining us.
Thanks for having me.
Great. In the first quarter, DCT beat the street's expectations. What drove those gains and how are things looking for the rest of 2013?
We had a good first quarter. We've had several good quarters now, and I think it reflects the continued recovery in the industrial market. Rents and occupancies are up in the markets, and our company did well. I mean, from both an occupancy perspective and a rent perspective.
And how do things look for the rest of the year?
You know, I'm optimistic about the market. I'm actually optimistic about the economy. Our customers continue to make decisions, lease space. Vacancies are dwindling, supply is in check, and as a result, rents are moving. And rents are the next step in the recovery, and it's something I'm pretty optimistic about.
And looking at your external growth over the next couple of years, where do you see the best returns come from, acquisitions or development?
I think that from our perspective, it's development and really taking what I consider value-added risk. We have an organization in place that is able to execute that in a way that's, I think, a competitive advantage relative to more passive institutional investors. There's a lot of money chasing industrial. At this point, a lot of that money, I think, overvalues yield or is yield focused, stable, and focused on stabilized assets. As a result, we've seen the pricing for stabilized assets at all-time lows in terms of cap rates. Highs relative in terms of prices. You're still able to develop or take on leasing risk by buying vacant assets at a cap rate that's probably 150 to 200 basis points higher than what an investor would pay for that same asset once stabilized in that marketplace. That's pretty attractive. So clearly we're going to continue to look for acquisitions, and we will find them, I'm sure. But for the most part, I think the opportunity, generally speaking, is development.
And with fundamentals continuing to move in the right direction, what do you see as the biggest concern in the near term for the industrial sector?
I think it comes down to two things, supply and demand. And supply, will the banks remain disciplined and on the sideline with respect to funding spec construction? So far, and I think for a number of reasons, it will remain this way, speculative construction and development has been funded by equity. Certainly the REITs, but also then private investors, primarily pension funds and non-traded REITs, have been through providing equity capital to private developers. That provides discipline that is very different than a private developer who is borrowing money. But if the banks do loosen up and lend on land make land loans and also lend on speculative construction, that's a risk. I don't think it's likely, but it's a risk. Demand comes from the economy, and I continue to be optimistic that the economy will continue a slow recovery. And a slow recovery for our business is not a bad thing. It does keep banks in check, supply in check. The new normal has been a pretty good thing for the public REITs and certainly for DCT.
Phil, thank you so much for joining us today.
Thanks for having me.
For more on this and other REIT news and analysis, be sure to visit REIT.com.